And we come to the part of the show where I talk about what I believe individual investors need to be focused on or understand before they make their investment decisions over the next couple of weeks. As always, we have three topics. And the first one, US inflation, CPI data, which was out earlier this morning, and the Fed decision that is about to be announced at 2 p.m. this afternoon. The second thing that I want to discuss is good news once again. A lot of people would say, well, isn't good news always good news? Well, not necessarily, especially when you're looking at inflation and trying to bring down inflation. And the third topic, are investors getting a little bit too confident? If you're an investor out there that's trying to invest money at this time at all costs and chasing those high flying names, are you maybe a little bit too confident? At times there are, when the market does pull back, there are times when the market pulls back, and sometimes that catches people off guard. So you don't want to be ever too confident. So we'll touch on that. So let's get to the first topic, U.S. inflation CPI reading that we received this morning and the upcoming Fed discussion. So we did receive CPI, Consumer Price Index. We got some numbers out of the U.S. this morning, and they were pretty good. They were to the downside, and they showed us that inflation is starting to come down once again. A lot of people were thinking that maybe things will reheat or start to get a little bit warmer with respect to inflation. We saw pretty strong inflation numbers in the first quarter out of the U.S., and we were hoping that that was just a first quarter thing. Coming into a new year, sometimes pricing and inflation gets distorted, and hopefully that we would see things start to come back down again. And so far, for the months of April and May, that is in fact what we are seeing. First chart we have on U.S. Consumer Price Index will show us just that. Here you have the headline number, 3.3%, down from 3.4%, was as low as just above 3% at the beginning of the year. We're seeing the core inflation, which is less food and energy, the volatile food and energy, down to 3.4% from 3.6% just a month ago. So we are starting to see inflation coming down once again. Our next chart here, Fed funds rate. You'll notice the big takeaway here is that on the far right-hand side, you'll notice a flat line, and that tells us that the Fed has not lowered interest rates in a little bit. They raised interest rates multiple times throughout 2022, and as we came into 2023, or at least the latter part of 23 and 24, things have kind of stabilized. And obviously, the Fed is no longer talking about raising rates. They think they are in a spot keeping interest rates restrictive in nature. And so they think they don't need to raise rates. The question now becomes, how long do they have to keep rates in restrictive territory before they reach their 2% target for inflation? And the Fed has actually said that they will cut rates before they get to 2% in anticipation of getting to 2% down the road. And we've seen other inflation data showing us that inflation may be somewhere around 2.6, 2.7%. I know CPI is a little bit higher, the numbers we got this morning, but we're getting there. The US is getting there. In Canada, our rates have been under 3% now for quite some time, and that's why we've already seen Canada lower interest rates already. The second topic to focus on, this idea of good news is good news once again. And what I mean by that is, for quite some time when we had a strong jobs number, strong retail sales, strong GDP growth, that spooked the market because individual investors were saying, oh my goodness, if things are so strong, central banks aren't going to be so quick to cut rates. So we wanted to see a bit of a weakening economy, a bit of weaker numbers so that the Fed and the Bank of Canada could cut rates. But at the same time, we don't want to see too weak numbers, so that not too hot, not too cold scenario, that Goldilocks scenario that I talk about quite often, not too hot for the data, but not too cold. That would indicate we are going into a recession. So when we receive, for example, jobs numbers out of the US and Canada this past Friday, the numbers, I believe, were warmer than expected, better than expected, but the market took it in stride as actually good news is good news. And we have some charts on this. We have Canadian jobs, I think is our first chart. You can see here that for the month of May, we created 27,000 jobs in Canada, which was well above what we were expecting. You can see not as high as what we created in the month of April, but nonetheless, we're still creating jobs. And when you have job growth, job creation, people are working, they're getting a paycheck, and they're spending money in the economy. We have our next chart here, which is a monthly job creation in the US. And you can see here that monthly creation, 272,000 jobs were created in the month of May, well up from April, not as high as where it was in March. But you can see that there was this downward path that started at the end of last year. The month of March was was a bit out of whack there, but now we can see maybe it wasn't, because May was how we had some significant job creation as well. So I guess the main takeaway for investors would be, when economic data is strong, that's not necessarily a bad thing. It just depends on which data points we're getting strength in. So for example, our next chart shows that Canada's average median hourly wages in all industries for the last 5 years is on the rise. Wages are on the rise. Now, that's great for all of us that are making more money, but not so good for the Bank of Canada, because we're seeing wage inflation. And wage inflation has been something both in Canada and the US that central banks have focused on. And so when people are making more money, they can spend more money chasing fewer goods, and there you have inflation. Our next chart here, and I believe, actually, no, we have two more charts. This is going to show you hourly earnings in the US. And to my surprise, you're actually seeing hourly earnings coming down. So again, maybe good for the Federal Reserve and the central bank in the US to see hourly earnings falling over the last, I guess, towards the end of or beginning of 2024. That's a 17-year period on this chart, but obviously not good for all of us, right? We want our hourly earnings to go higher, not lower, but from an inflationary standpoint, not a bad thing. So again, if we were to see some positive data there, that might be inflationary and worry the markets a little bit. And lastly, on this topic, retail sales, another topic that I think when you receive a number, not too hot, not too cold, we're seeing that retail sales, our last number here, US retail sales was actually pretty flat, not much growth whatsoever. That is a bit of a problem, right? Because that just tells you that the consumer is not spending as much as they were in the previous few months prior to that. And could this mean that the consumer is no longer has the ability to spend as much? Could this then eventually be a factor into how the growth numbers look like in the US and obviously in Canada down the road? If the consumer is not spending, we know the consumer makes up about 70% of the economy. So if the consumer stops spending, that could be a problem. That could be a problem for growth in both Canada and the US. So a number like retail sales, we want to see a good number, but not necessarily not too good, but not too bad. So with certain data, good news is good news once again. With other data points, you might hear that good news may not be so good when you're battling inflation. The last point I want individual investors to consider before you make your investment decisions is this idea about, are investors too confident? And, we've seen markets go up quite a bit over the last, let's call it 6 months. And we have a chart that will show year to date by month how the markets have fared. And really, with the exception of April, the only time that the markets actually went down, and we have that here. This is the S&P 500 index, a month by month chart on the S&P 500 index. We can show that chart right now. There it is. And you can see here, the only month that things went down was the month of April. All the other months, things were pretty good. The S&P 500 went up pretty well. And it's funny, in the month of April, I did receive many calls from investors asking me what's going on. Should we be sellers because things look like they're falling? Well, obviously back then we did not know that the months of May and June, so far in June anyways, things would look pretty good, and that any losses in April would be made back up in May and June. But at that time in April, things looked bleak, right? The Fed was talking about not cutting rates anytime soon, and market was slightly, according to some, overvalued. So investor confidence at that point, or investors having confidence in the markets, actually went down. People were getting nervous again. And now here we are, markets back at all-time highs. So I guess the point I wanted to make with regards to investors being too confident at times is, you got to take what investors are doing and saying with a grain of salt. They're reacting emotionally to what's going on in the markets, to what they're hearing in the markets, what they're hearing in the media. And at times they get overconfident and they take markets to all-time highs. They chase those high-flying stocks. And it's funny how that confidence can erode, how quickly it can erode like it did in the month of April. So you want to be mindful of that, not to chase the hot stock. And I think we have a couple of more charts to show how strong the market has been this year. The S&P year-to-date bar chart here, you have a lot of bars. And the main thing, without showing the bottom, it's tough to see the numbers along the bottom, but you can clearly see how the S&P has gone from the bottom left to the top right with respect to how well it's done, with a bit of a blip in the middle, which was the month of April. And if you want to talk about the area where the growth has been most prominent, that has been technology. The Invesco QQQ ETF really is the one ETF that tracks the tech sector. And you could see here, once again, that as of November 1st, all the way up to present day with a bit of a sagging in April, the tech stocks have been on a roll and have done extremely well. So yes, there has been reason for individual investors to be confident, to become more confident, but you always want to, keep things in mind. You want to stay diversified. Don't chase the hot stock. Keep looking at those PE ratios. Keep looking at their price to earnings to their growth. You want to keep measuring these investments against other investment ideas, peers, competitors, things of that nature. So you can never get too confident. And in my opinion, those are the three things that I think individual investors should consider before you make your investment decisions.